The Vox Markets podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.
Welcome to the podcast on Friday, the 30th of April, 2021. On the podcast today, Jason Tebb, CEO of OnTheMarket, provides some insights into the property market, which is experiencing sales volumes not seen since 2005. Also on the podcast, Dashwood Brown, Head of Investor Relations at Anexo, discusses some of the highlights from their full year results, which showed continued growth and net cash generation despite COVID. Plus, Russ Mould, Investment Director at stockbroker AJ Bell, talks about dividends and buybacks. Plus, at the end of the podcast, I have two lists for you. The top 5 most followed companies on Vox Markets in the last 24 hours and the top 5 most read RNSs too. Check out both these lists at voxmarkets.co.uk. We'll also see lots of other content. There's an article there on Salt Lake Potash. There's one there on Gene Drive. Also one on Altona Rare Earths. Plus Tech Capital hails record results. And of course, our COVID-19 index. Biggest rise there today. Gene Drive up 23% to 89.5. And biggest fall there is Synergen, down 10% to 131.9. Check that out at voxmarkets.co.uk.
Vox Markets is an online community of investors that runs a free mobile and desktop platform that allows you to track news and updates about any UK-listed company, offering RNS push notifications, detailed charts, pricing data, and much more. Find out more at voxmarkets.co.uk/app.
And joining me on the podcast right now is Jason Tebb, CEO of OnTheMarket, and that's OTMP ticker. Jason, thanks for joining me.
My pleasure. Good morning.
Yeah, and we thought we'd get you on to talk about the property market at the moment, because it's been in the headlines, it's everywhere. But as always, before we do that, for people not familiar, of course, you're new as a CEO, people not familiar with the company, just explain OnTheMarket if you could.
Of course. So OnTheMarket.com is a property marketplace. It's sometimes referred to as a property portal. And that's where estate agents, letting agents and house builders advertise their available properties across the country. And then we introduce them to consumers who visit the site, search for those properties of interest and engage directly with those advertisers.
Yeah. Well, do you know, every morning I do a top 5 macro things, themes that are hitting the headlines financially. And today my number 1 was about the property market, saying how busy it is. And so double the property sold since last year, and since records began, it's been the hottest since 2005 or something. I mean, is it like that? Is that really the case? What's it like from your perspective, Jason?
Well, there's certainly a lot of noise around the market at the moment, that's for sure. And most people focus on those house price index movements and stories about queues of people waiting for new build properties to be released. But the real temperature check, I think, is all about those transaction numbers. And I tend to look at the HMRC residential transaction data to understand what the market really looks like. And so I suppose to give you an idea, in a normal year, the average number of residential properties sold is around just under 100,000 per month, which is 1.1 million properties every single year. And that's been the case for the last few normal years. The last time there was a real surge in the market, which you'll remember, is 2006 and into 2007. And in that time, the number of homes sold was significantly higher. And the seasonally adjusted stats, broadly speaking, are in 2006, it was something like 1.68 million, 2007, 1.61 million. And if you split that into quarterly numbers, taking again the previous high in quarter 1, 2007, that was just under 440,000. So let's compare that to now. And in the quarter just gone, which was Q1 21, there were just over 455,000 transactions. And March 21 just gone is also a new monthly record with just under 191,000 completions against that average, remember, of about 98,000 in normal pre-COVID months. So it's pretty clear that statistically, at least, it's the busiest sales market since records began in 2005.
Yeah, it's exactly almost 90% up in the month there, and we look at this on the backdrop of this. Where's it coming from? We've had COVID, it's pandemic. So, what's the impact on buyers? Because, like I say, you mentioned 2005, 2006. I think that was when I was in Cardiff. I remember people just offering, putting offers in on properties they hadn't seen and above the asking price just to get a property. And what's happening at the moment? Is it like that now?
It is, and it's a combination of a number of things at once, if I'm honest. First of all, obviously, the low cost of borrowing with record low interest rates. Mortgage lenders are very willing to lend. The market's super competitive, especially for those with more equity or higher deposits. Secondly, there's huge pent-up demand, as you say. And you remember that back in December 2019, we saw really busy months due to the outcome of the general election, and there was a sense of certainty around Brexit. And a lot of those would-be movers had put off making any of those decisions early on in 2019 till after the election. And that meant January and February last year saw a huge increase in those looking to move, and that Boris bounce was only just getting started when, as you say, the first COVID lockdown came in, and that meant that many home movers' plans were put on hold. But that latent demand throughout those lockdown periods kept on building, especially as people were spending so much time at home. And then they translated that into this surge of activity when estate agents were allowed to go back in May. And obviously it was stop-start up until really the first part of this year. And I think that's why we've now seen this huge surge in demand. And I think also there's the obvious stamp duty holiday and the extension. Yeah. And clearly that's had a massive impact. Positive sentiment fuels these discretionary movers. And as you know, sentiment fuels markets. But the impact we're now seeing is that in most areas, properties at all price points are going under offer much more quickly than they've done when compared to a normal pre-COVID year, which was probably the last one was 2019. And some things are going under offer within days of launch.
Yeah. Well, do you know what? I've seen that obviously prices go up as well because I get the notifications from the app there on the market, and I've seen, my area, the prices seem to have gone up. And from your perspective, just tell us what it's like. I mean, is traffic good? I mean, what are you doing differently there? What's the thoughts?
So traffic's good. We're seeing some really good numbers in terms of consumer traffic. We're delivering really good numbers of leads to our agents. But what we're doing and have always done is for those people who are seriously committed to moving, we're finding at the moment it's not uncommon for them to see something on the site midweek, and then when they call an agent on a Saturday morning to arrange a viewing, there's already been some interest. And so on the market, we're trying to give buyers that competitive advantage in their property search. And when you come to our site, you can see new properties first and therefore jump to the head of the queue. And we do that through our new and exclusive proposition, where our agents support us by uploading thousands of properties every month, which appear on our site 24 hours or more before Rightmove and Zoopla. And in a fizzy market like this does give buyers a real competitive edge and gets them access to the latest properties before they're listed elsewhere. And we've also got just under 1,000 agents who list exclusively with On The Market, as well as those agents who support us with new and exclusive. So buyers who are serious about moving really need to look at On The Market as part of their property search and register for property alerts to make sure they see absolutely everything that may fit their budget.
Yeah, no, that's a real, sort of power to your arm there when you have that, that if you're searching, seriously, like you say, for a property, and you've looked at all the options that's out there, that's fit your filter already and doesn't really suit you, you're just looking for the next new property to come up, and if you get a head start on the other portals, it means a lot, doesn't it?
Yeah, I think you're absolutely right, and I hear it anecdotally, and you're hearing it in the press. Someone will. Busy working people will see something come online on a Wednesday via conventional portals. They'll call up on the weekend and it's already gone. And they haven't even had a chance to do it. And that's their first available day to be able to view. And therefore, buyers in a market like this need to get an edge. They need to get access to properties before they go on the full wider market. And I think that's what we absolutely deliver.
Yeah, get an edge. That's exactly it. Marvellous stuff. Okay, Jason, if someone's listening and likes the sound of what you're doing but are not yet following the story, give them 3 quick reasons why they should hit that follow button on your page on Vox Markets and add On The Market to their watch list, please.
Well, they should definitely hit that follow button. And I think there's 3 reasons why. And the first reason is we've had strong growth in both our key metrics and in our financial position. Not only are we seeing growing consumer awareness, as I mentioned before, but we're in a stronger cash position now year on year, and we've got increasing revenues. And that means we can now invest in people and products, but all within our framework of prudent cost management. I think, secondly, we've started a really exciting new phase of our growth, an ambitious roadmap which will see On The Market become more than just a property portal, with a suite of new products and services, many of which generate revenue and therefore will combine to grow income from the existing customer base, as well as help onboard new agents to the platform. And thirdly, as we talked about earlier, we have a different proposition from the other businesses in this space. We focus on new and exclusive properties that are either listed 24 hours before Rightmove or Zoopla, or indeed aren't available on other property search sites at all. And we're now developing further ideas of differentiation to give us serious property seekers an advantage in that property search.
Marvellous stuff. Jason, good to chat to you, and hopefully we catch up in the not-too-distant future. Thanks very much.
And to you. Thanks very much, Justin.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Nick Dashwood Brown, Head of Investor Relations at Anexo. ANX is ticker there. Nick, thanks for joining me.
Hello, Justin. Nice to see you again.
Yeah, and you've just announced your final results for the year, ended the 31st of December 2020. Of course, it's almost 4 months out of date. Time is flying. We're still on the tail end of this COVID thing. So, and look at the results. You've held up quite well. We'll get into that in a bit. Before we do, Nick, people maybe not familiar with Anexo, can you explain what you're about, please?
Yes. Anexo is an integrated credit hire and legal services group. We act for the non-fault motorist, somebody who's involved in an accident which is not of their doing. We provide replacement vehicles at commercial credit hire rates to that motorist until either their vehicle is repaired or they're in receipt of a cheque for the value of the vehicle from the at-fault motorist's insurance company. And we specialise in impecunious claimants, in other words, people who basically don't have any money and who would otherwise be unable to access a replacement vehicle while theirs is being repaired.
Yeah, and like I say, 2020, it's been a standout year as far as being odd is concerned, and like I say, it shut down the economy, and you would have thought your business would have grinded to a halt, and maybe it did at a certain point, but it's held up well for the rest of the year by the looks of it. So take us through the financial highlights if you could. We're going to operational next, but financially, how has it been this year, all 2020?
Our revenue numbers have been extremely robust. Revenue's up by 10.5%, 86.8 million. And our operating profit is down a little bit in line with expectations. But that is actually reflective of the fact that we've invested hugely in expanding the business in terms of investment in staff, in terms of IT costs associated with that, and also with expansion of the VW emissions case. That's something I'll come to later on. We have an earnings per share figure of 11.4 pence, and we are paying a final dividend of a penny to make it 1.5p on the year.
Absolutely, yeah. Well, let's like I said, very robust. So operationally, what have you achieved this year, and Nick, that you're proud of?
Well, we're very pleased with the way we've come through lockdown and the pandemic in general. Both our businesses, that's the credit hire side and the legal services business, are essential businesses under government guidelines. So we have remained open throughout the pandemic. Now, in terms of the credit hire, as you would imagine, our vehicle numbers dipped at the beginning of lockdown and came right down as people came off the road. But an awful lot of our customers are people who are classed as essential workers. So they're supermarket workers, national health workers. We do a lot of courier business with motorbikes. So they've been on the road throughout. So actually, having seen a decline in our fleet size, that bounced back very robustly towards the middle of the year. We saw another dip down when the second lockdown came in. But once again, we're seeing good recovery rates there. We expanded our staff numbers in the legal division, and that has meant that cash collections have continued to increase. It's very straightforward. The more staff we have, the more cases we can settle and the more cash we collect. So that has remained extremely strong throughout the course of the year.
Yeah, okay. And most importantly, I mean, looking forward, the market always looks forward. What's coming? I feel a general sense of bullishness. I was looking at, I think it was the boss of Barclays Bank saying we'd do a rebound as big as the rebound happened post World War II. So, what's it like looking forward? Are you confident, Nick?
Our vehicle numbers remain very robust. We're confident in the fact that our cash collections will continue to rise. It's important to mention the VW emissions case, and for those of you who are not familiar with it, VW emissions case is a class action against Volkswagen about the subversion of key air pollution tests. Mm-hmm. The High Court has already ruled that VW is liable for this, and VW have been refused leave to appeal. We act for approximately 15,000 claimants in this action, and we're awaiting further developments on that. But we hope for further developments in the second half of this year, and that is something which potentially has the potential to be extremely significant for our bottom line.
Yeah, absolutely. Marvellous stuff. Well, it's good to see that. And Nick, as always, if someone's listening and likes the sound of the progress you're making this year but are not yet following the story, give them those 3 quick reasons, if you could, why they should hit that follow button and add you to their watch list.
Sure. We continue our recruitment in terms of our legal services and credit hire division, and expansion will continue there. We have the VW emissions case, which has the capacity to be a potential huge kicker for our bottom line as we go through 21 and into 22. We're also establishing a new housing disrepair team, which is looking at problems within social housing for a lot of our customers who tend to be who tend to live in social housing and perhaps be at the lower end of the income scale. So there's potential for huge growth in the advocacy division within legal services, and our core business continues to be very robust, not quite pandemic proof, but certainly coming out of it extremely strongly. And we look forward with optimism to 2021 and beyond.
Excellent stuff. Nick, good to chat to you, and hopefully we'll catch up in the not too distant future. Thanks very much.
Thanks, Justin. Okay.
The Vox Markets Podcast with Justin Waite.
And joining me on the podcast right now is Russ Mould, Investment Director at stockbroker AJ Bell. You all right, Russ?
Yeah, I'm well, thank you, Justin. You okay?
Yeah, I'm good. I'm feeling I don't know if it's me, but it's feeling it, more optimistic, bullish-wise. I mean, there's lots of good figures come out from the vaccines, and they said now some parts of the country are not infected at all. We've got this date, I think it's 12 market trading days till we open. The economy in March.
That'll be right. Yeah, 17th. May 17. Yeah, that's right. Very
so
good.
It's getting closer. I saw. Did you see Barclays' boss today saying that?
I did.
He said something like it's going to be the best boom since World War II for the economy. Apparently, so it's all a bit bullish, isn't it?
Let's hope. Well, yeah, so he's right. Equally, the FTSE's up 40% from its lows.
Yeah.
And a lot of cyclical stocks are up a lot more than that. So I think some of it is in the price.
Yeah.
But equally, when I try and keep a little record of companies that miss earnings expectations against companies that beat them, and there are very, very few misses, and there's a big long list of beats, which I think you would have to take as definitely some sort of positive.
Yeah.
You are still seeing dividend payments. I think I found, and I keep a record, I think I found 1 or 2 companies announced a dividend cut in April. One of them was one of them was BP, that everybody knew was coming anyway. Yeah. Although there were lots of companies that didn't pay a dividend because they're still keeping it. Informa was one, for example, in the FTSE 200. So there are still companies definitely keeping HSBC, for example. So there are companies definitely keeping it tight, but they didn't pay one a year ago. So again, we're sort of the comps are soft. You're not seeing things getting any worse. And on the dividend front, I think for the 4th month in a row, dividend payments and restorations have outperformed dividend cuts and done so pretty handsomely. So we've now actually had companies announce since last March £72 billion of dividend payments and restorations against £52 billion of cuts. So we're back in credit, which I think is an interesting thing. And one of the questions I often ask one of the things I always think about, what ends a bull market? Well, it's generally when the money runs out, right? Yeah. Because it's been spent on something silly, or it's been misallocated, or people have overpaid for something. So you've had 72. This year you've had 36 billion pounds come into the kitty from dividends. At the thick end of another, let's have a look. Thick end of another 7 billion coming from buybacks, which we'll talk about in a minute. And I don't, I'm just doing the tallies now, but I don't think we've got to anything like that amount of capital raising from companies in terms of primaries and secondaries. So I know Dark Trace is trading very strongly today. Deliveroo was a bit of a disaster, but you haven't seen the level of new IPOs and secondary offerings from companies either raising money or sellers in IPOs selling a second slice. That cash is not outstripping the cash that's coming in. So you would view that again as supportive for the market at the moment. And I guess buybacks is fascinating, because a year ago, if I'd said to you, companies have just announced £7 billion of the share buybacks, you'd have looked at me like I was a Martian. I mean, you'd have just been like the dash for cash a year ago. Companies were hammering away at their dividends. I mean, in March and April last year, we saw £26 billion worth of dividend cuts. as companies just went, okay, we don't know what's happening, but we don't like what we're seeing, and safety first, slash the dividend, slash spending, hunker down. Whereas now there are some companies who clearly feel that the world is, that they are, quote, generating excess cash, and therefore they're looking to return it to share. And that includes 10 FTSE 100 firms this year. The ones who took the plunge this week, which is why it's caught my eye, were Unilever and BP. And again, you wouldn't have thought that BP would have, quote, had excess cash a year ago when oil prices were trading negative. Yeah. So, now it wasn't a big one at $500 million, but nevertheless, it's intriguing that companies feel sufficiently confident. I guess the question you need to ask yourself now is, as a shareholder, is that the right thing for the companies to be doing? Because, again, IMI, the engineer, talks about keeping an efficient balance sheet this week, which means we've got plenty of cash. It's not earning anything. So it's depressing our returns on equity. It's depressing our returns on capital. If we get rid of it, that will boost our returns. Now, in the end, you still need cash to pay the bills, right? As we all discovered a year ago, and unfortunately, some people are still struggling now. So it's interesting that companies are starting to worship again at the altar of the efficient balance sheet, and that does mean that when things go wrong, as they did last year, you might not have enough cash, as much cash lying around as you thought. So that's something that you've always got to be careful of. Now, IMI, even last year, generated double-digit operating margins and generated cash. So it's clearly a very fine company. So I'm not going to hold them to account. But some companies that did run efficient balance sheets, quote, airlines, found themselves in deep stuck last year because they didn't have the cash buffer that they needed going into a downturn. Now, nobody can predict a pandemic, but you can't tell me that there isn't a downturn coming at some stage of some kind or other. So I think one or two companies did get caught on the hop. So I'm always a little bit wary of companies that just worship at the altar of the efficient balance sheet. But if they genuinely have excess cash and genuinely have low debt or no debt, low debt to equity, good interest cover, and good free cash flow that looks pretty dependable, then once they have paid all their bills, paid all their tax, and invested in the business, then the case for a buyback is more defensible. You then need to move on. It's how disciplined are they with the buyback? Because I've done the work, and I know Bernard Looney's got a very difficult job on his hands at BP, $500 million buyback. He looked pretty pleased about it to say, look, this is a signature of our health. And clearly the shares have responded a little bit this week. But BP has bought back between $35 and $40 billion worth of stock since 2005. And it has done nothing for the share price.
Yeah. Well, I've always thought, when I first started investing, I was reading about, I always thought I didn't understand what buybacks were, why they did them, and I also thought it was a bit of trickery. Is it trickery, really, or balance sheet trickery, or not?
I think there's an element of that. The argument is, one, we're earning nothing with cash. So frankly, as long as we make sure we've got plenty lying around, it's holding back our performance metrics.
Yeah.
And if you buy back shares, your share count goes down. You're not losing any interest income, so your earnings per share go up, and therefore it can be earnings accretive. So there's a little bit of a financial accounting benefit. And if you're a shareholder, and I think the awkward thing with buybacks is that as a retail investor, you don't often get to participate because they're generally done for the benefit of institutional holders. But so as a retail investor, what happens is your share, your stake, your percentage ownership of the company goes up. Mm-hmm. So your percentage claim on its cash flow goes up. So you could view that in the long run as a good thing. You could say, now, let's just take the extreme example of Apple. I think Apple launched a $90 billion share buyback this year. I can't remember the exact mathematics, but Apple, when it started doing share buybacks in 2012, when Carl Icahn was breathing all over it, I don't think Apple's far away now from having bought back its entire market cap when it started buybacks in 2012. Mm-hmm. So in effect, if you bought an Apple share in 2012, you've had all of that expenditure returned to you, and you still have a share in the company. Yeah. Ding. Yeah. So in extreme examples, buybacks can be incredibly powerful things. But where they can go wrong is if companies borrow money to do it, which at the moment looks tempting because debt's not costing you anything either, but that leads you into trouble if you've got no cash and loads of debt going into a downturn, as companies found out last year. And the other thing you've got to be wary of is, how do companies buy back the shares? Because if you're a shareholder, if you're an investor, what are you trying to do? Buy low, and if you want to, sell high. Yeah.
Yeah.
How many companies, except for Next, set a price limit on the share buybacks?
Yeah. But
They just don't. And if anything, what you do, I mean, how many companies were buying back shares last year when they were 40% lower? None. How many companies are buying shares back now when they're 40% higher?
Yeah.
I mean, I'm not being funny. It's not how you run a portfolio, is it? So I think in that respect, that's what you've got to be. Next, always say, this is our price limit, because after that, it doesn't help our return on equity or our return on capital employed. The math don't add up. It's no longer earnings accretive. How many other companies do that? Well, I can't think of very many. So I think, and that's my point about BP and Shell. They generally buy their shares back because they've got cash flow because the oil price is high, and the oil price is high means the share price is high. Duh. So really what they're doing is buying at the top. Well, that's not what you're supposed to do as an investor, and I can't believe it's great for long-term value creation as a company that now it hasn't stopped Apple returning all that money. Don't get me wrong, but that's a kind of extreme example. But I think where you've got to be careful is what price they're paying. Now, what's interesting is the banks, is the big UK banks are all trading less than book value. And that is prime time for buying back stock, because in theory, you're buying pound coins for less than £1.
Yeah.
And that, does that make sense? And that's when you're really supposed to do it. And Barclays have sort of nibbled their way in. Standard Chartered has nibbled its way in. Let's see if the others follow.
Yeah. And which is, remind me, which, in fact, we said this before, on AIM, pretty much you get startups, companies, and they are diluting shareholders when they're starting out, of course. Hopefully,
exactly.
This is the opposite of that sort of concentration of reduction of
Correct.
capital. So, but is this what Buffett is a fan of? He's a fan of something. Is it buybacks he likes, I think, or not?
Buybacks under certain
as long as there's a
circumstances,
good
and he's
deal.
very clear in that. And again, it's the two criteria he lies down at. Are they still investing in the business? Are they, covering all of their bills? And are they still investing in their competitive position? I.e., are they engineering products, or are they engineering financials, which was your opening question? And also, are they paying a sensible price? He said if you're buying them cheaply below book value, it makes absolute sense. Mm-hmm. What you often find, though, is buybacks are pro-cyclical, in that they tend to be done when share prices are high and profits are strong and debt is cheap. And they don't tend to be done when profits are low and things are difficult and share prices are depressed, when actually you get the best value, as we know, if you buy when things are depressed. So I think in that respect, you've got to be a little bit careful. And they do tend to be a bit of a bull market phenomenon. And yeah, if you look at the buyback data for 2008 or 15 or 20, there were virtually none when share prices were absolutely rock bottom. And there were loads and loads of them at market tops. So I am personally relatively sceptical, so long as they're done in an incredibly disciplined way.
Mm-hmm. Yeah. Marvellous stuff. And what's your thoughts on the economy and stock market over the next, say, 6 months? Do you think we're going to a blowout spend, like they say?
Well, certainly walking around Brighton at the weekend, I know it's a bit harder to tell because nobody's allowed to sit inside. But it might create a bit of a false impression. But certainly the pavements and the streets have been packed for the last 2 weeks. We haven't still got stag and hen parties coming around, but I'm sure it's only a matter of time.
Yeah.
And it does feel as if, those people who've kept their job and not been furloughed have got money in the kitty. They're not commuting, and I think they're generally inclined to spend it. And I think, therefore, you will get a spring back. But equally, this concept of the K-shaped economy, where lots of people are struggling out there, and I've been doing deliveries for a food bank over the winter in Brighton, which I would like to think is a relatively affluent place, and there are clearly people out there in Brighton who are finding life extremely tough. So I think you will see differing fortunes, but overall it feels that in the West confidence is returning. Even in Europe now, I think you're starting to see vaccination programs get going. Clearly, lots of companies this week have been talking about different pace of recovery in different parts of the world. Latin America is very tough right now. We know that India is having a very, very difficult time. And that may hold the global pace of recovery back a little bit. So I think in that respect, it could be a slightly more uneven recovery than people expect. Equally, what I am hearing from companies, there's a lot of companies now talking about input cost increases, raw material increases, shipping increases, maybe first signs of wage inflation if you look at the Office for National Statistics. And that does, again, make you think, are we finally going to see the return inflation. And I think I'm very much, the markets are obviously on their guard about that, and that's something that we need. But central banks are saying, no, move along, nothing to see here. It's transitory, base is soft, oil prices are up on massively on where they were a year ago. Move along here, nothing to see, don't worry about it. And I think inflation will only really take hold if you start to see food price inflation, which, if you look at the price of corn, soybeans and wheat, by the way, there's no, and hogs, they're at multi-year highs. And if you look, it's food price inflation that is, if it proves sustained, is what drives inflation, because that's when it really hits people in the pocket, and that's when they start going to their boss and demanding pay rises, particularly if unemployment's relatively low. Now, right now, I'm not sure how many people would feel really confident enough knocking on the boss's door, assuming that their boss is in their office and all that business, to demand a pay rise, because you've still got a lot of people on the furlough scheme, unemployment still, 5 or 6%. But if that comes down, and we are allowed into the office to knock on the boss's door, that might start to change. I think so. There are things at the moment that are working against people getting too aggressive on pay rises. But if you start to see that is when inflation has become entrenched and mindsets begin to change. I remember my parents telling me that in the 1970s, when inflation was running at 15 to 20%, if you wanted a kitchen, you made sure you bought it now, because it was going to be 15 to 20% more expensive very, very quickly. And that is when you don't have just money supply growth, but you have velocity of money. And that's when you really do see inflation. So that you can see that sort of the bonfire is all piled up and ready to go. You're just waiting to see whether something lights the spark or not. And I think that's something that we do still need to be careful of from an investment point of view, because if inflation does come, a little bit is fine. But as we saw in the 70s, too much is bad for virtually any asset class that you can think of, except maybe gold and raw materials and property. And the only companies that really come out of that then are those with genuine pricing power, which is things that you simply have to buy. So that's things that you stick down the throat or stick down your loo, or unfortunately buy to shoot people with, where they're generally, unfortunately, were the best sectors that did held up relatively well in the 1970s, apart from the gold miners. So, and it would be a major, given that we've just had a 40-year equity bull market, a 40-year bond bull market, commodities have been massively underperforming for the last 10 years and are actually relative to equities no higher than they were 27 years ago. That would mean that everything that you and I have seen during our professional careers would be different. So it would be a huge thing if inflation came back. It would be a complete playbook changer. Yeah. And so if bear markets and bull markets, bear markets don't necessarily always destroy wealth, but they certainly see a wealth transfer. And I think that in that respect, if you did get inflation, you would again see a transfer of, those people who've got property or those people who've got real stuff, access to gold and things, would probably do relatively okay out of it. Those who haven't would find life really, really tough. So again, central banks are craving inflation because it helps erode debt, but it doesn't mean that everybody would win by any stretch of the imagination. So again, it's got to be once you take the top out the bottle, it can be hard to, get inflation back in again. So it's a very difficult balancing act.
Yeah, absolutely. I know. Do you know, it's fun, and talking about sort of macro and trying to predict and formulate policies for the future. I was looking at I think a BBC article or last night on the news there saying that many predicted house prices would crash for Brexit and food prices would go up. And it's pretty much gone the other way around. House prices have gone up. Obviously, no until the pandemic coming, but I think food prices didn't go up as much as people thought, and house prices have gone up rather than down.
They're tickling up now, but house prices, again, the government's just thrown money at the housing market.
Yeah.
The problem that you've got there is that what happens when you do switch off Help to Buy, and you do switch off the stamp duty land tax exemption, and you do switch off the 95% mortgage guarantee scheme.
Yeah, that's worrying because there's pent-up demand at the moment. But as soon as you cut that tap off, I know what happens. Yeah.
I think that's the tricky of it. You do have a market where you have fundamentally got demand outstripping supply still. So I think that's a positive for house builders. I think the fact that the government is politically determined to make sure that house prices don't come under pressure economically. In the end, if you want to make housing more easier for people to buy, and we'll just let prices go down. But obviously politically that's very difficult. Doubly so, and economically, if you just encourage people to leverage themselves up the kazoo to get hold of their first property, you don't leave them with negative equity for the next 20 years of their life. But that's what happened in the 1990s, and in the end people came through, but it wasn't very funny. So it's a bit of a distorted market, and I think that given that government unintentionally or intentionally seems to be taking an ever greater role in markets, housing being a classic example, tied to regulation of tobacco, gambling, and other, and which some people will think is good and some people think is bad. And the kind of slightly steering banks towards where they're lending and this drive for green infrastructure programs. I know there are lots of very smart investors out there who are following this and saying, well, actually, to really make money now investing, go where the government's determined to spend it, because there's going to be an awful lot of it sloshing in that direction. Yeah. Maybe not so much of it sloshing in other directions. So follow the money. And I think that is something that we all possibly need to consider. Now, that does mean that things are probably going to be very tough for oil companies, for example. And yet, at the same time, we talked about oil, 6-9 months ago as being really interesting, because oil stocks were at their lowest percentage of the global market cap. Exxon had just been kicked out of the Dow Jones, and they performed brilliantly since then. So that's slightly blowing your trumpet, but it equally going what's really, really deeply unpopular can still be interesting. Absolutely. And oil is going to get no love from government at all. None.
Well, when you are it's like the thing is, when you are in a super oversold situation, but there's still demand. I mean, I think at the moment, all demand globally is still slowly, is it 1% or something, but it's still growing a little bit because emerging markets still use a lot of oil and stuff. So it's, but we all know the long-term trend is down, but there's still a short-term trend of it bouncing, and maybe even a mid-term trend. So it's different cycles, isn't it? The length of these cycles.
Exactly, and frankly, given that that renewables are still, I would guess, barely 10% of global energy supply, we can't. That's not going to go from 10 to 100 in a hurry. Yeah. I'm sure that we're all hoping by 2050 we're net carbon neutral and all the rest of it. But it's just unfortunately, whether we like it or not, oil is going to be with us for a long time. And I know we're all oil analysts worried about stranded assets and this and that, but oil is going to be with us for a long time. And it's hard to find an industry, barring maybe tobacco, that you can argue is publicly more unpopular. But unpopular doesn't, but it's buying what's obvious and popular is what generally gets you into trouble. Yeah. Buying what's unpopular and not obvious is quite often, looking at it purely from the narrow perspective of portfolio performance, is often a very good place to be. And oil is proving that, at least at the moment, and certainly over the last 6 or 9 months anyway. Mm-hmm.
Marvellous stuff. Russ, good to chat to you. Any plans for the weekend?
Great. The weather forecast is dreadful, but my lads are due to play cricket on Monday. Our daughter's due to play hockey Saturday, Sunday. And I'm helping, because I'm now sort of head of boys cricket at our local club. I'm in theory overseeing some under-9s and under-10s cricket matches, their first ever cricket matches, which is a little bit like watching the Keystone Cops run around sometimes, which is great. It's great if you ever remember those black and white films. Yeah. But I do fear the weather could intervene, in which case I'll just be hunkering down at home, and I've got a couple of mates coming round for a curry, sat with our coats on and the beer jacket on in the back garden tonight. What about you?
Nothing. We got builders around, and so the house is upside down, and so we're just going to stay. We can't go at the back because all the patio's been ripped up. We can't go at the front because the front of the house has been done. So I'm just going to stay in the house. Maybe take the dog for a walk a couple of times. That's about it, really. There we are.
Hunker down.
Yeah, it's domestic spending. See, builders, people. I think building do well at the moment.
There you are.
But
there's loads of that going on in Brighton. Take it from me.
Yeah, absolutely. Marvellous stuff. Russ, thanks for that. Speak next week.
Keep well.
Okay, it's time for the top 5 most followed companies on Vox Markets in the last 24 hours. They are at 5, Gene Drive. At 4, Space and People. Gene Drive's up 23.45% to 89.5. At 4, Space and People, up 8% to 12 pence. At 3, Futura Medical, up 30%, pretty much to 59.26. At 2, ADVFN, up 1.47% to 69 pence. And at 1, Mosman Oil and Gas, it's up 12.5% to 0.18. Okay, let's look at the top 5 most read RNSs. They are as follows. At 5, Hurricane Energy, proposed financial restructuring. At 3, Rambler Metals and Mining, posting of annual reports and notice of AGM. Well, not the most exciting. At 3, Gene Drive, big rise today. Approved by Indian regulators, their COVID-19 PCR test. At 2, Synergen, home cohort data of SGO's 16 phase 2 trial. And at 1, Omega Diagnostics launch of VisitTech COVID-19 antigen and update. So the SP went down on that. So I'm assuming it wasn't blow away news on that, but who knows. Okay, that's it for the podcast. Thanks for listening. Muchos appreciate.
The Vox Markets Podcast with Justin Waite. Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy anything based solely on a tip or recommendation. Please do your own research.